and he is an enrolled agent and certified tax strategist. He's spoken to us many times before. One of the things I really like about his presentation is he does an excellent job of fielding and answering questions. And a lot of the value of a tax program is to get the answers to questions that our participants bring up, and that really amplifies and clarifies a lot of the points that will be made. So Russell's presentation title is 2024 Tax Changes for Investors and Year-End Strategy. He is an enrolled agent and certified tax strategist, more than 20 years of experience, and is CEO of Silicon Valley Tax Coach in San Jose. He provides comprehensive tax and accounting compliance services for small businesses and individuals, as well as proactive tax planning for business owners and investors to legally reduce the amount of money they pay in taxes, which is a goal I think we all have. He has saved more than $7 million over the last 6 years alone. And let's give a warm welcome to our speaker. And I'm looking forward to, and I'm sure you, to his presentation. Thank you.
I start?
Yes, go ahead.
Okay, great. Welcome everyone. Thanks for joining me on this Saturday morning. It's the most wonderful time of the year, right? At least for tax planners, because for proactive tax planning, you have to look ahead and not behind. If you come to me in February, March and say, hey, how can I save taxes for 2024? I'd say, I don't know, maybe contribute to an IRA if you can. That's about really all you can do after the fact, so it's a good time of the year to take stock of your income, do projections for how your results have been for your investments and earnings, and see if there's anything that needs to be done to help avoid any shock in April, as well as minimize the pain if you can. So anyways, thank you for joining me. So as Lynn did a brief intro, I'm actually not sure about that $7 million. I haven't checked recently. I probably told him that. I had put 3 million. That's a big difference though. So I'm going to go with the conservative. I know I've saved at least $3 million. It may be as high as 7. I have to go back and look at my list. I'm sorry. So I've been an enrolled agent since 2005. Enrolled agents, if you're not familiar, are licensed by the Internal Revenue Service, as opposed to a CPA, which would be licensed by a state accountancy board, or an attorney, which is a state bar association, of course. So only EAs, CPAs, and attorneys can represent taxpayers before the IRS for collection and audit matters, and they all have equal rights to practice before the IRS. So we can't go to tax court. I can't do a certified audit, but other than that, we can do the same thing for when it comes to taxes. So certified tax strategist, I specialize in proactive strategies to help client legally minimize their taxes while meeting their financial goals. Because as we'll talk about in a couple of moments, those two can not always be the same thing. You don't always want to minimize taxes. We want to always make sure that we're minimizing taxes while also meeting your other needs and goals. So, and as a certified real estate tax strategist, we also have specific expertise in working with real estate professionals, landlords and dealers, brokers, wholesalers, flippers, etc. So we also try to make sure, when it comes to real estate investors, typically liquidity is king. And so we want to make sure that we're making the smart choices in order to allow them to leverage their investment as much as they can, while being tax efficient and investing smartly. So, and then we also, of course, do compliance work for our clients as well. Annual tax filings for those clients who need it, and for small businesses that wish to outsource their accounting and bookkeeping functions, we'll do that for you as well. So, this this presentation is being recorded. It will be posted on the AAII Silicon Valley YouTube channel, is what I'm told, along with a link to a PDF of the slides for reference afterwards, if you wish. So. And without that, I think further ado, so just as a quick overview, we're going to do a brief introduction, We're going to talk about what's changed in 2024, not a whole lot. What's changing in 2025, as of right now, not a whole lot. And the 2026 tax apocalypse, when the 2018, actually it was 2017's Tax Cuts and Jobs Act provisions, which took effect in 2018 through 2025, will largely expire as if Congress does not take action to extend or change them. So, and then we'll finish up the presentation with some year-end tax considerations, general kind of smart moves to consider making or look at as you take stock of your investment portfolio and other tax matters for the end of the year. It was mentioned at the beginning that I'm happy to take questions throughout the presentation to make sure that your questions are as close to on topic as we can get. They will be asked through the chat, though, because of the number of attendees. We're not going to take audio questions, so please leave yourself muted. Put the questions in chat. We have the moderators that will be monitoring that and ask the questions of me there. I will give the disclaimer that when it comes to questions about taxes, the answer is always the diaper answer, which is depends, right? And so if you start to ask something that's too specific or too nuanced for me to be able to answer quickly, I will just let you know and then move on. I will do my best to answer the questions, but we want to make sure that we don't get bogged down answering things that are specific only to you or applicable only to your specific situation, out of courtesy for the rest of the attendees and in the interest of staying on schedule. Yeah. We have 2.5 hours, so we have quite a lot of time. I do expect to be able to answer any questions that are asked throughout the presentation. So let's go. So just a brief overview. Most of you should already be aware of these things, but we have different types of income on the tax return in general. We have ordinary income, investment income, capital gains and losses, passive income, self-employment income, and qualified business income. And income can be more than one type at the same time. Like investment income could be interest, which is also ordinary income. Capital gain is also investment income, right? Self-employment income can also be taxes, ordinary income, et cetera, right? Qualified business income has been around for several years now, so hopefully most of you are familiar with it by now. But it is a special type of income that is earned by businesses that pass through its income to the owners for individual tax purposes, right? So we're talking about sole proprietorships, rental properties that you're operating and reporting on your Schedule C and E on your personal returns, or partnerships and S corporations, or even sometimes trusts that pass income through to the individuals for taxation, as opposed to like a C corporation, which files and pays its own taxes. This was introduced by the Tax Cuts and Jobs Act, and the reason for it, or at least the rationale at the time, was because the Tax Cuts and Jobs Act lowered the tax rate for C corporations from it used to be marginal and bracket based, like the individual taxes. They lowered it to a flat 21%, and so Congress wanted to create some semblance of parity between the different types of taxes in order to, so they're lowering the federal tax rate effectively on this business income in order to make it a little bit more equal with the C corporation. So whether it actually does that or not, it depends on your situation. So types of income taxes, or I'm sorry, types of taxes that you'll pay on your tax return: income tax, self-employment tax, early withdrawal penalties, net investment income tax, alternative minimum tax. Not as many people pay that these days as they used to, although that may change in 2026. The Medicare surtax, which is your 3.8% a Medicare rate on earnings above $200,000 or for an individual filer, or $250,000 for a married couple. It is an additional 0.9% tax, raising the rate from 2.9% to 3.8% for higher earners. And then you can sometimes have to repay credits, and mental health services tax applies to California income. So if some of our visitors from out of state may not run into that one. And that only applies to taxable income over $1 million per year in California on each return. And therefore, many of our California attendees may also not have encountered that either. So do we have any questions before I move on?
Yes, there is one question in chat. If there is a QBI on IRA investments, what are the obligations we would on reporting on it annually? Can it be just ignored because IRAs are all eventually taxed at income tax rates on later distributions?
Yes, any income event inside an IRA can generally be disregarded. It doesn't hit your personal tax return until you take the money out. And then what type of income it is irrelevant. As you say, it'll all be taxed as ordinary income upon distribution. So
That's the only question so far.
great. So I have this conversation like several dozen times per year. And so I just always like to highlight that your tax rates are marginal, not retroactive, meaning that if your income moves you into a new bracket, it doesn't increase the tax on the income that came before it. And a lot of times people will be very concerned about which tax bracket they're in. I tend to take a somewhat lesser view of that, of the importance of that, because most of the time the difference is only 2 or 3% of the income, difference between that falls within a bracket. So in other words, if the 10% bracket applies to taxable income between like approximately $0 and $11,000, and then it goes up to 12%. So if you have $11,500, then $500 would be subject to 12%, and $0 to $11,000 would still be subject to 10%. And that is how tax brackets work, right? And so there's so if your income increases and falls into a higher tax bracket, your tax on that income below that bracket doesn't increase. Only the marginal income is taxed at the new rate. And so I always like to remind people to keep that in mind. Yeah. And at the bottom is the most important reminder of all. You will always have more money after paying taxes on your income than if you don't have income, right? We're not taxed at 100%. I mean, and because additional income doesn't increase the taxes on the income that came before it, that means you're always going to be better off. Even if you pay the highest marginal rate in California, that can be as high as 51 or 52%. That means you still have 48% more cash in your pocket after paying taxes than if you don't have the income. Now, of course, nobody likes to pay more than they have to, and it's always better to pay 35% instead of 50%, right? So we don't mean to discount that, but we want to make sure that you don't focus too much on your tax bracket and focus more on the overall investment that you're making. Now, if that's true for income, that's also true for deductions, right? Because if you take that same logic and say, hey, you'll always have at least 48% more cash in your pocket if you have the income and pay the tax. That means that if you spend $100,000 on a deductible expense or a donation, you're going to save, I don't know, $50,000 to $52,000 at most, and most of the time less than that, meaning you'll have $48,000 or more less in your pocket than if you didn't, incur the deduction. And so we also don't want to make decisions about your deductions and donations based on taxes, more or less, right? And so this falls under the heading of don't let the tax tail wag the dog, right? They are an important consideration as you decide what to invest in and when to exit, but your overall investment goals and market conditions are far more important in most cases. And this is a conversation I have even more often than the other question, or the talk about marginal tax tax rates. A relatively minor downward shift in the value of your investment because you're waiting to try and maximize your tax benefit or minimize your taxes can easily wipe out any savings, right? And so, all else equal, sure, spread it out and try and make sure that you're, not paying more taxes than you need to. But if it's the right time to exit an investment, then it's usually the most important thing is to time the exit based on your investment decision, not based on taxes, right? So if you look at something like Tesla in 2021 or Nvidia in 2024, right, where we've had rapid appreciation, and you say, okay, well, we don't know yet about Nvidia. Maybe it'll have better legs, but we know in 2022 Tesla kind of took a dive, as did most tech stocks, right? And so if you were holding on to your gains in December, trying to make sure that you got your long-term capital gain rate instead of short-term, you may have ended up losing a lot more than if you had just sold it when you thought it was a good time and paid the short-term capital gain tax, even though it's more painful, right? So on the side here we have Nimona, my dog, just to remind you again not to let the tax tail wag the dog. So just a little bit of humor, I think. So
there's a
she's
question regarding Irma. Do you want that later or
yes,
now? Okay,
I can take it now.
regarding the Medicare surtax Irma, My one-time stock sale boosted my AGI higher and consequently a surtax. How would I win on an appeal to the IRS in explaining the sale was a one-time incident?
Sure. So IRMA, for those that aren't familiar, which may not be many of you, but if you're not, IRMA is a mechanism that the Social Security Administration, actually not the IRS, uses to require higher earner people to pay higher Medicare premiums, right? So the normal premium this year is about $145 for Part B, I believe, right? And it'll raise to about $155 next year. No, 174 and 185. I'm sorry, I'm a little behind. So, and so if your income goes over certain thresholds, then they're going to increase the amount that you're supposed to pay, or that you're required to pay for your Part B premiums, right? And so the Social Security Administration does this on a 2-year retroactive basis, meaning they're going to look 2 years back in order to determine this, right? So as to how to win the appeal, I have no idea. It seems to be kind of not quite arbitrary. The only direct experience I have with this is that my mother-in-law did a Roth conversion many years ago, and I told her to expect this and that she could appeal it. And she appealed it, and they sent her back something 6 months later saying, no, we're not going to approve your appeal, but we'll give you a refund anyways. I'm not really clear exactly what happened there, but she did end up getting, I think in general, if you're able to demonstrate that it's just a one-time boosted income. Another time this sometimes happens is if once you retire, you sell your home and you have a large taxable gain because real estate has gone up a lot in the last 20, 30, 40 years, right? This can sometimes also happen. So it's it can be up to, I think, $500 a month
Per person.
per person. Yeah. So it's quite an increase from 174 to about $500 a month. And again, my mother-in-law did get a retroactive refund of her increased premium, so it is possible, but I don't know exactly what happened there. So I'm not sure. Yeah, but anyways, so again, sometimes people are, they're retiring, they take a payout of their accrued vacation, they rotate their investments and rebalance their portfolios and take some money off the table. You sell your home, you're doing a Roth conversion. There are a lot of things that can just temporarily boost your income for 1 year. And so it is important to keep that in mind. It will be 2 years later that you'll see that adjustment. And it is appealable. Unfortunately, I'm not familiar with the specific mechanism of that. Can't answer that question any more than that. So,
And then it should go back to the lower rate the next year, correct?
yes, because assuming that your following year was a lower income year, again, they're looking 2 years back. And so, yes, it should go back down in theory. So, yeah.
All right, that's the only question. Thank you.
All right. So again, Nimona reminds you with this nice, cute look on your face to not let the tax tail wag the dog, because you want to make sure that you're making your investment decisions on all of the different factors, not just taxes. Same thing for your deductions that you're planning and stuff, right? So for 2024, there wasn't a whole lot that got through Congress this year in general, right? Political polarization, general gridlock, and the presidential election. There's not really been any major tax law changes. The House of Representatives actually passed a bill in January 31st of this year that would have made some retroactive changes to 23, but it never even got a vote in the Senate, as far as I'm aware. I think it never got out of the Senate Finance Committee for reasons that I've never really understood. It seemed like a non-controversial bill that had bipartisan support, but it never got a vote. So, and so there haven't really been any changes passed this year. However, there are some things that were passed in prior years that took effect this year or that will take effect next year. So we'll start to look at some of those. So.
There's a question
Any
about
questions?
Roth conversion. Is there a time limit for completing a 2024 Roth conversion?
Roth conversions are taxed in the year that they're done, meaning that the deadline to do a Roth conversion for 2024 is December 31st, 2024.
Thank you. That's all.
So updated figures for 2024, standard deduction is rising to $14,600 for single filers, $29,200 for married filing joint, and $21,900 for head of household filers. That's up a little bit from the prior year, just in line with inflation, basically. So, qualified charitable distributions, QCDs for 2024, they're actually increasing for the first time ever from $100,000 to $105,000. Qualified charitable distributions are made directly from your IRA to a qualified charity. You have to be subject to required minimum distribution, meaning that your age currently has to be at least 73. And the money that you distribute to the charity directly from your IRA does not get counted as income on your tax return, meaning you also don't get a deduction for the donation, but it does count towards your RMD requirement, right? Your required minimum distribution. And so this often is a good way to make effectively tax-free donations if you don't itemize, right? We're looking at a $29,200 standard deduction for a married couple. If you're over the age of 65, you also get an additional, I think, $1,900 each, right? And so you can have a $32,000 standard deduction, and with the limitation of state and local taxes, capping your deduction for property taxes and state income taxes at $10,000. If you have your house paid off, you may not be itemizing, right? If you're not paying mortgage interest or making really huge donations, right? And so the qualified charitable distribution is a smart way for many retirees to make donations on a tax-free basis without, even if they don't itemize. And even if you do itemize, it can also help avoid increase or adjusted gross income, because if you take the distribution, that becomes part of your adjusted gross income, which has impacts other places. So even if you're getting a full deduction for the donation, it can still also reduce. Sometimes you have QBI or credit phase outs. You can have income limitations for the electric vehicle credit, which we'll talk about in a moment. You can have, if you're trying to deduct medical expenses that are only deductible to the extent that your income's over, or the deduction's over 7.5% of your income. If you put in an extra $100,000, that means $7,500 less is deductible of your medical expenses. So those are some considerations. Yeah, but primarily we advise clients that are not itemizing, but are taking required minimum distributions to make their. We encourage them to make their donations this way. So. Gifting limits. Go ahead.
There are several questions. You said QCDs
Sure.
can't be made until you're 73. Isn't it 70 and a half, but they won't apply, since you're not taking an RMD, it won't apply to the RMD.
Possible. I'm sorry. Actually, my understanding has always been that you have to be required to the subject to RMDs. It is possible that I'm incorrect there, and if so, I apologize. So
yeah, as others have commented, we don't believe that the age change for QCD, and the 73 is the new RMD age. If you are already required to take RMDs, you're still required, even if you're under 73.
Correct. But I believe it's been enough time since the Cure Act that pretty much anybody who's taking required minimum distribution should be more than 73. But you're also correct in there. That should have been clarified. So
yeah, last year was the confusing year, was those that were 72. For gift and QCD limit, do they change amount every year according to inflation, or need in legislation to change amounts every year?
The gift limit, I believe, is indexed for inflation. The QCD, I'm not familiar with because I've never seen it increase before. Those have been around for several years now, and have not changed. And now they're going 5%, $5,000, 5%. So it does suggest that they're indexed, but I've not seen the specific rule on that. So,
can a QCD come from a 401k or 403b as well as IRAs?
I believe they're IRAs only. That could.
I believe you're correct.
I don't know that for sure. I'm sorry. So,
our gifts to children.
Typically,
sorry.
I believe they're only from IRAs. So.
Are gifts to children exempt from your personal taxes?
Gifts have no bearing on your income taxes. They're not deductible for you. They're not generally taxable to the recipient. So,
yeah, this is just a comment to fill out the SSA 44 to contest IRMA, and what the results will be determined by IRS and Social Security. Has there been any serious effort to increase the 3,000 maximum capital loss that carry over from year to year?
Not that I've heard of.
Okay. That's all. That's all. Thank you.
Okay, great. So the gift annual gift exempt gifting limit is $18,000 in 2024, up from $17,000 in 2023. As we'll cover later, it's also going up to $19,000 in 2024. That is indexed for inflation in recent years. So for a quick overview of this, so the United States does impose an estate tax on on large transfers of wealth from one generation to another, or from one person to another upon their death, in order to avoid the vast majority of people ever having to deal with it. Then there's a certain amount that is exempt from this estate tax. It's currently about 13.9 million, I believe, and meaning that if your net worth is less than that, and that's per taxpayer, so for my married spouse that'd be doubled. If your net worth is less than that when you pass away, then you're not going to have to worry about this, right? However, to avoid wealthy people just giving away all their money so they don't have anything when they die, and avoiding the estate tax that way, there's also a gift tax levied on transfers between people while you're alive. And that limit is one and the same. It's a unified credit, meaning that if you so anyways, again, most people don't regularly run into this because there's an annual exemption amount. Right now it's $18,000 per person per year, meaning that each individual can give up to $18,000 to as many different individual people that you like, kids, grandkids, cousins, favorite tax preparer, whoever, right? Without having to have any impact on that lifetime exemption, right? But above that, you start to use up that lifetime exemption, right? We'll talk later about the fact that this lifetime credit of $13.9 million, or transfer credit or limit, is set to revert down to about half in 2026 if Congress doesn't take further action. And we don't know exactly how that'll play out, but the IRS has publicly committed to not clawing back any exemption that was used up above that, what we think is going to be around $5.6 to $6 million. So if you have a taxable estate, I'm sure you're already talking to your planners, or if you will, after that credit goes down, then you should already be talking to your estate planning attorneys to figure out the best strategy, etc. But that is something to keep in mind as well. So if you look at a typical situation, we get most commonly is that, a parent or a grandparent will want to help someone with a down payment, right? And they'll say, okay, well, this means that you can give, if you're married and the person you're giving money to is married, then you can give each of those spouses $18,000, and then the other person, and then your spouse can also give $18,000, meaning you can transfer up to $72,000, right? In 1 year, without having to worry about filing a gift tax return. If you give more than that, then you would, yeah, that's the right number. Sorry. If you give more than that, you would just need to file a gift tax return notifying the IRS that you made this gift. You'd be reducing your lifetime exemption, and still would most likely not owe any tax, right? We also have a opportunity at the end of this year where, if you can plan ahead that much and are feeling particularly generous, you can also give an additional $19,000 to each of them, and your spouse can do the same for 2025, right? And so you can always kind of bunch up those gifts between the end of 1 year and beginning of the next, if there's a requirement to. So, anyways, 401k contribution limits increased to $23,000 this year, up from $22,500 in 2023. The Roth IRA contribution limit remains at $7,000, or earned income, whichever is lower. There's a catch-up contribution for both of those, $7,500 for 401k, and $1,000 for an IRA. So
there's one more question you partially answered. Does only cash to children count towards the gift limit, or buying a car also limit to it? Who pays the taxes above 18,000, parent or the child?
Any transfer of wealth, including, I'm sorry, I'll give you an important caveat in a moment. But yes, buying them a car would be a taxable gift, potentially, or at least would count towards that limit. There are the exceptions of if you're making payments directly to a medical facility, or for medical expenses, or to a college for college tuition and fees, then that does not count towards the gifting limit. So there's also a special provision for college savings accounts for 529s, where you can give up to 5 times the annual limit in 1 year, and then file 1 gift tax return, and then not have to, as long as you don't make taxable gifts in the subsequent 4 years, you can treat it as if you made it ratably over 5 years. That allows you to kind of front load your 529 if you are feeling generous and have the means to do so. Because as we're aware, time value of money is a real thing, and your gains will be much higher over the course of 18 years if you start with a larger balance in the 1 year instead of contributing every year for 5 years. So,
And the question on the taxes, the receiver of a gift doesn't pay the taxes, it's the parents, correct?
yes, and it would only be a gift tax, and only if they exceeded their lifetime limit for giving.
Please explain bunching gift into next year.
And so that's just because the limits are each calendar year. That was just a concept of like, hey, if you make 1 gift on December 31st, it would count as a 2024 gift, right? And another gift on January 1st, it would count as a 2025 gift, right? Or however you want to engineer it, because it is just looking for which calendar year the gift was made. So
Thank you.
the reality is that IRS doesn't really have a way to enforce this unless you're filing an estate tax return later. They may look for large transfers of wealth. If you're changing title on something, like such as real estate, that's something they may pick up on and be able to research after the fact. It's generally voluntary. The vast majority of people will never pay gift or estate tax, because of the very high limits today. Whether that'll be true in the future, we don't know. The gift and estate tax exemption has gone all over the place, from $600,000 back in like the early 2000s to $1 million, $1.5 million, $3 million. There was 1 year where there was no estate tax, and now then it went up to $5 million, and then up to with TCJA it went up like way really high, and so it can be a little bit tricky to try and plan, not knowing what the exemption will be when you die, and so. You just kind of have to factor that in. If you're a person with a significant wealth, you have to factor in, some flexibility into that. And another thing to point out, though, is that oftentimes when you're considering gifts and estate planning, tax savings are not always the #1 priority for whoever's making the plan. So you also have to factor in your own considerations. Oftentimes, control is control of what happens to the assets after you're gone can be a more pressing concern than just pure tax savings. So I hope that answers that question. So
Yeah, and there's one more. If I receive from an estate 80,000, do I pay tax on the amount above 18,000?
the recipient does not pay taxes on a gift. The only exception is that if you are a beneficiary of a retirement account, when you take money out, you'll pay tax on it. But the actual inheritance of cash, real estate, stock, cars, collectibles, or even the retirement account itself, the act of inheriting it does not trigger income tax. With the retirement account, if you take the money out, it triggers income tax. So.
And if there is income tax due on funds from an estate, won't you receive a K-1?
A K-1 is the mechanism that pass-through entities, including an estate or trust, would pass through your share of taxable income from that entity, right? So if the trust exists and sells a home and there's a capital gain or loss, or there's a liquidation of an annuity or retirement account, or selling of stocks that the decedent left behind, then there will oftentimes the estate or trust will issue a K-1 to the beneficiaries, because estates and trusts pay tax at the very highest rates, income tax rates, starting at around $12,000 of income, whereas individuals have up until around $500,000 or $600,000 of taxable income before they start paying those top rates. And so it's almost always much cheaper for the beneficiaries to pay tax individually on the income than for the trust or estate to do it direct themselves, right? Right? Which is intentional, I think, by Congress. So
yeah, there's no relation between income tax on an inheritance received and the gift tax amount.
So yeah, again, the actual Yes, the gift tax and estate tax is the same thing. It's the same rate with the same exclusion. It just a gift tax happens when the person making the gift is still alive, and then the estate tax happens after they die, right? But so the inheritance does not trigger income tax, but the assets that you're inheriting may have generated income before they transfer to you, and you may end up owing tax on that. Somewhat common, or not, at least not unusual example of this would be if you're the beneficiary of a life insurance policy, right? The actual benefit that you're receiving is not taxable, but oftentimes there'll be some interest that the insurance company has to pay you in between when the person passes away and when you actually take ownership or get the money, right? And so the same thing would apply, if someone inherits a bunch of a stock portfolio, then that actual transfer of the assets isn't taxable. But if there are any interest or dividends paid out on those stocks, then that would be taxable, right? So I hope that clarifies that. But again, the receipt of an inheritance is not a taxable event, but there may be tax implications for what you're inheriting after it becomes yours. So,
what benefits, if any, is setting up a gift trust account with, say, Schwab?
I'm not sure what that refers to. Maybe a donor advised fund. If that person could clarify, then I'm able to answer what
Okay.
they mean by
Yes,
the donor
they're
advised
saying,
fund. Yeah.
they're saying, are you covering that later in the presentation?
I am actually, and in the last section when we talk about year-end consideration. So I think I will table that and answer it later. So we've, I think, covered everything on this slide. If there are no other questions, I'll move on. Anything else?
How is the tax basis a gift or inheritance of stock paid by the recipient?
That's an excellent question. So basis or tax basis is the amount that you would calculate a gain or loss from if you sell the asset, right? And those are two different treatments, right? When you receive a gift from the person while they're still alive, you keep their basis in whatever they're giving you, right? As well as when they purchased it for calculating long-term or short-term gain on any liquidation, right? So if you inherit something after they die, then the basis is the value at the time of death. And this actually brings up a very good point. Is that it became common for a while for parents to add their children to their home before they die in order to avoid probate on the transfer of the asset to the children after they die. But this eliminates the step up in basis, right? When they die. And so, because when you receive a gift, let's say, okay, we're going to put our only child on the title as joint tenants, means they own half of it. And then if, you pass away, then your half of the property gets a basis adjustment, and then their half does not, generally, right? There can be a life estate, provision that's created that can still allow a step up. But this has an unintended tax consequence for their kids, for most people that are doing this, right? Nowadays, especially in this area, I think more people are savvy to this, and they're allowing, they're making like a living revocable trust in order to avoid probate rather than making this, while still preserving the step up in basis. So as you get towards the end of your life, it's a little bit macabre, right? But it's a little bit morbid, but you have to start making some decisions about whether you're going to be gifting things during your life or allowing them to be passed on with a stepped up basis when you die. And that can be a very real consideration to make, that I have this conversation with my older clients frequently when they're talking about selling one investment or selling their home so they can move into, like, say, a retirement community or a smaller place, or move to be next to the grandkids or wherever, right? And so we always have to have that conversation about, okay, well, what's the best way to do this, that's going to meet your immediate needs, but also hopefully preserve as much of your estate as possible for your heirs, because assuming there's no consequence currently for the move, most people would prefer to hold on to their money and pass it to their kids or grandkids or charities of choice or whatever than to give it to the government. So
thank you.
Yeah. So a number of years ago, of course, they passed the Secure, and the Secure 2.0 provision. I probably should have capitalized those because they're acronyms, as is most things in Congress and in the government, right? I think it's setting every community up for retirement. I don't remember, but anyways, so there's no longer minimum distribution requirement for Roth 401ks, which had not been clear before. And emergency IRA distributions are now allowed without early withdrawal penalties up to $1,000 every 3 years. Those can be repaid within 3 years, and then you can always make another contribution, right? Or a distribution if you need to. 529 to Roth IRA rollovers are now possible, right? Which is, there's going to be another slide on this next, right? And RMDs are required from IRAs, inherited IRAs, and it's for real this time. There'll also be a slide on this in a moment. So, and then the IRMDs this year started at age 73. So
There's a question
so these
about,
again are things that were passed in prior years and are now taking effect or now are in effect. So
question on the previous, the stepped up basis when one spouse dies and later when the second dies. How is it handled?
Most of the time I'm dealing with California people, because we've invited people from Michigan and I don't know offhand whether they're community property state. I will clarify, right? So in a community property state is commonly considered 50-50, but it's really not. It's each spouse owns 100%, an undivided 100% interest in the community property, right? So in a community property state, when one spouse dies, the entire basis gets adjusted. We call it a step up, and it normally is, but I always feel compelled to point out it sometimes is a step down. It's just a basis adjustment to whatever the fair market value is. Traditionally, that's almost always a step up, but it's not always, and so we want to keep that in mind. So, but yes, the basis will be adjusted to the full basis will be adjusted to the fair market value at death, and when the second spouse dies, it will also be adjusted 100%. Right? In a non-community property state, you'll have only the person's portion of the ownership will get a basis adjustment, and then when the second spouse dies, their portion would get a basis adjustment as well. So,
Thank you.
all right. So this is fairly new. I believe for 2024 is the first time it became possible, and so there's been a lot of excitement about this. There are some pretty strong caveats on this. So the 529, starting in 2024, it's possible to roll over funds from a 529 to a Roth IRA with the following limits, right? First of all, the account must have been established at least 15 years ago. So this isn't really meant for current college students. It's meant for people that have already graduated and have some extra money left over, perhaps, right? Or have finished their schooling in other ways, right? The aggregate amount is limited to $35,000 and is also limited to the maximum allowed Roth IRA contribution each year, meaning that if their income's too high, they don't get to do any of this, right? Or if they have no earned income, they don't get to do this. And then this rollover counts as towards their annual contribution limit. So it's not a freebie. It is something that it is a strategy that can be used to move leftover funds after the beneficiary finishes college or schooling, and you don't have to pay the tax or penalties that you normally would have. I had one client liquidate the remainder of their 529 in 2023, and that was unfortunate because I didn't have a chance to have this conversation with them about whether this could be a way to avoid the taxes and penalties they had to pay. So they may have decided to do it anyways. I don't know. So are there any questions about this?
Would you like to have the estate questions held till later in the presentation?
No, that's fine. We can answer them now.
So can the 13 million for each spouse be preserved? There's some portability of unused, but that's it, right?
Yes. Well, yes. I'm trying to parse out what they mean by this question. So, yes, the unused portion of the deceased spouse's estate tax exemption can be ported over to the surviving spouse for the last several years. And so in practice, that means that sometimes clients that don't have a taxable estate when they die would still want to file if their spouse passes away. This, especially given that the annual exemption amount is scheduled at least to go down in 2 years, right? And so you can preserve, like if someone passed away in 2024, unfortunately, right, then you could port over the $13.9 million 2024 estate tax exemption onto the surviving spouse, so that when that spouse passes away, their estate tax exemption will be whatever it is that year, plus what they ported over from the predeceased spouse, right? This eliminates the need for a B trust in many cases. And so if you have not updated your trust document since before that became a thing about 5 or 6 years ago, I believe, I actually don't remember exactly when portability started, then you may want to revisit that, because I do end up seeing some clients with that have a deceased spouse, and due to before portability was a thing, then it was very common for the estate plan to say, okay, take the annual the estate tax exemption amount of assets and put it into the B trust, so that it'll be out of my estate and therefore won't be subject to estate tax, right? And then typically the income and assets of the B trust can be used for the benefit of the surviving spouse until they die, right? And so that often is no longer necessary if it's purely being made for an estate tax reason, right? There can also be remainder beneficiaries that are different from the surviving spouse's beneficiaries, especially in a blended family. That could also be another reason that's not related to this, right? And so there could still be a reason for a B trust in your planning. In my own personal family living trust, it actually has a provision that says make a B trust if you need to avoid death taxes, and don't if you don't, right? As far as I know, I'm the only person that has that provision in their trust, but that gives some flexibility, because if you're typically drafting your trust document with the laws that are in existence of the time. In this case, that was 15 years ago, right before my first kid was born, and we've not had to update it, because it doesn't say, put up to $1.5 million if we have it, right, into the B trust, because that may have been the estate tax exemption that year. I actually don't remember what it was back in 2009, but just as an example, right? So at least my attorney at the time said that he had never seen anything like that, but it seems to be pretty clear, right? We don't want to incur the administrative and tax compliance cost of a B trust if there's no benefit for it, right? And because the B trust is typically irrevocable, right, once the first spouse passes away, then they can be difficult to unwind, and so you can leave your surviving spouse and heirs with this ongoing compliance cost and bother. So, and then
Does the Roth limit of 7,000 make the 35,000 limit irrelevant?
$35,000 is lifetime, right? So at the current rate of $7,000, you could do this for 5 years and use up to $35,000. The $7,000 limit is annual. So,
who can claim the 529 funds for a Roth IRA? Can the trustee, the beneficiary, both?
I believe it's only for the beneficiary, and I believe that the beneficiary is it has to be the beneficiary for at least 15 years in order to do the 529 and to Roth rollover into an account under the beneficiary's name.
Okay. I'm going to add, there was one question about community property with right of survivorship. Do you know how this differs from joint tenants with right of survivorship? And in changing title for a house simply done by re-recording the title?
I don't know. I guess, I mean, the name of it suggests that perhaps joint tenants with rights of survivorship aren't necessarily married and don't have community property. That's a question of law, unfortunately, that I don't really know the answer to, whether there's a difference between the two of those. Community property with right of survivorship or joint property with right of survivorship is relatively new in the last couple of years, and can be a way to transfer title upon death to a designated person without transferring title while you're alive, still avoiding probate, but also preserving that stepped up or basis adjustment to the fair market value at the time of death of the decedent. So it was kind of way for people that only have real estate, that's their primary asset that they need to pass on. It can be a way to avoid probate without a trust and without transferring title during the life and creating a taxable gift and or foregoing the basis adjustment upon death. So,
Okay, thank you.
so this is new this year. IRS sort of new. IRS notice 2024-35. 2024 means it was a notice issued this year. 35, I think, is the number of the 35th notice they released, right? So they issued the final regulations that they've been threatening to do since Secure was passed, right? Specifying that beneficiaries are required to take requirement distributions if the decedent was required to take RMDs, and the account must also generally be liquidated within 10 years. There was some confusion upon the changes of the Secure Act, which required the account to be liquidated within 10 years of inheritance, right, or of the decedent's passing, as to whether or not required minimum distributions were required, right? Assuming that the person who died was subject to RMD requirements, right? So the IRS has always taken this position, but has deferred enforcement of the penalty for not taking an RMD until now. Now they're saying it absolutely, you have to take the RMD for 2024 and forward, and you also need to liquidate the account within 10 years. So that's something to keep in mind now. Some people have been taking RMDs the whole time. Sometimes people have been saying, no, if I don't have to take the money out, I want it to go tax deferred as long as possible and pay the income tax as late as possible, which is reasonable, right? And so you can still just take the minimum amount each year and then take a liquidation of the whatever's left in year 10, if that's your plan. So at the bottom, it's just a reminder. The non-spouse IRA beneficiaries must generally liquidate the IRA within 10 years and are also subject to RMD requirements if the person who passed away was of RMD age. So just to highlight that this is now no longer a proposed regulation or ruling or whatever you call it, right? This is now the actual rule. They will enforce the RMD penalty. As an aside, though, I've never actually seen the IRS assess a penalty for not taking requirement distributions unless the taxpayer voluntarily reported it. Usually, if we get a client that has not taken RMDs for a couple of years because they didn't realize they had to or forgot or thought they had or whatever, we just kind of take them in the year that we discover this, disclose it on their return, and the IRS has never come back and assessed that penalty in the prior years. Doesn't mean they can't or won't. It means that so far I haven't seen it. So,
Two questions. If a child
Mhm.
inherits the Roth IRA, is the RMD exist for those inheritance? Is there still a 10-year limit?
yes and yes. Yes. So we have to remember that the point of a requirement distribution is that the IRS wants to tax the money in your IRA, right? And so they want to make sure that you don't just keep this money and growing tax deferred indefinitely and never pay tax on it, right? So same thing for a Roth IRA. They don't get to tax the money that comes out, but they want to make sure that the assets aren't growing indefinitely for for more than 10 years tax free. And then you can just take the money when you retire in 20, 30, 40 years or however, depending on how old you are, right? And so there is no required minimum distribution for Roth IRA while the account owner is alive, but there is one as well as the 10-year liquidation rule for Roth IRAs upon death.
Does the inherited IRA 10-year rule also apply to spouse?
Depends on how old the spouse is and how they like to treat it, right? Generally not, no.
But do they need to move it to their own name to avoid the rule?
I believe yes. I think that from memory, which may not be perfect, I apologize. I think that depending on the difference in age of the spouses, there can be a longer than 10-year period allowed if they don't roll it over to their own IRAs. But if they roll it over to their own account, then yes, they would not be subject to that 10-year requirement. So, and also, a non-spouse beneficiary can't roll over the beneficiary IRA into their own account. They must keep it as a separate account because of those RMD calculations. So,
For stretch IRAs that were in place before this law, does the 10-year rule apply?
I don't believe it does.
Okay, the last question I see is, can you do QCDs with an inherited IRA?
No, I don't believe you can.
Okay, thank you.
I'm not perfect, especially when it comes to these questions that I don't get very often. So if someone knows differently, please speak up in chat and I'll be happy to be corrected. I don't want to be giving inaccurate advice. So someone already corrected me on the QCD age requirement, which again, I could have very well been mistaken on. So I don't pretend to be perfect and I only know what I know. So electric vehicle tax credits became much more complicated, but also somewhat more available starting in 2022, right? And so these rules have been in place now for over almost 2 years. And so, but I wanted to kind of go over because there's a lot of confusion about them, right? New electrical vehicles that plug in and are not just a hybrid. A plug-in hybrid can qualify. A regular hybrid that does not plug in does not, right? The vehicle must have a final assembly point within North America. The MSRP of the vehicle must be $80,000 or lower for vans, trucks, and SUVs, or $55,000 or lower for all other vehicles. I don't know that these have been indexed for inflation, right? But this is MSRP for the package of the car that you are buying. It does not include any additional markup or taxes, fees, licenses, et cetera, that you may pay. So it does just go on the MSRP. So I know when I bought my EV in 2022, inventory was scarce and you had to pay more than the MSRP in order to get, to buy it from the dealer. But that was before these rules kicked in. So, but in that case, if I had paid a dealer markup above MSRP, that wouldn't necessarily qualify me as long as the MSRP was $80,000 or lower. I bought an SUV. So, prior to the IRA, the Inflation Reduction Act of 2022, there was no income limit. Now there is. The limit is $150,000 or lower for non-joint returns, or $300,000 for joint returns. Right? You can use, however, whichever year. I'm sorry, the current year or the prior year to qualify you. So even if your income is greatly increased in this year, but the prior year you were under the limits, you may still be able to claim a credit for 2024 or 2025, et cetera. Right? Starting in 2024, I believe, is a dealer now reports the EV sale to the IRS, and only the person listed on that report can claim the credit. So if you buy a car for your kid, right, or for whoever else, right, and they're the one that's on title of the car, then they're the only one that can claim the credit, unfortunately, right? I did have that question earlier this year with someone, and I had unfortunately had to tell them no, because the parents' income was too high to qualify the credit, but the kids wasn't. But because the parent was on the title of the car, they weren't able to claim the credit for the daughter wasn't able to claim the credit, right? So you can transfer the credit to the dealer as part of your down payment now, starting in 2024. So you can just say, here, $7,500, and that's part of my down payment. And there are no manufacturer limits anymore. I want to go ahead and point out, though, that you do have to reconcile the credit on your tax return, right? So if you transferred $7,500 to the dealer and then later on don't qualify because your income is too high, you're going to have to pay that $7,500 back, right? So you got to take that in consideration. But however, it's not a refundable credit. And so if you have someone buying an EV that doesn't have $7,500 with the tax, they can still transfer that $7,500 credit to the dealer and not have and get more benefit than they would if they just claim that credit on their tax return, right? And so that can also be. I had a situation. It was a unmarried couple where one partner needed to get a new car and was planning to buy an EV but wasn't working, and so they did this, right? They the other partner, of course, paid for the car, but they put it under the other partner's name and transferred that credit to the dealer and got a full $7,500 benefit, even though they were not going to pay any income tax anyway. So some planning can be available to maximize its benefits. So. Starting this year, there's also a credit available for certain used EVs. Can be up to 30% of the purchase price, up to $4,000. Must be previously owned with battery capacity of at least 7 kilowatt hours. Purchase price must be $25,000 or lower. Car model must be at least 2 years old. Car must weigh less than 14,000 pounds, which really I don't know of any cars that don't. unless you have like commercial vehicle, which is basically, I think, what this is intended for. And the credit only applies for the first transfer. If you sell the car again later, the second buyer doesn't, or the third buyer, as it may be, does not get a credit for it. You can only claim the credit once every 3 years per taxpayer, and the income limits are $75,000 for non-joint returns and $150,000 for joint returns. So if you're selling a used, I don't know, Leaf or a plug-in hybrid, perhaps you might be able to get this credit if the purchase price is less than $25,000 and you meet those income requirements. So I believe if you're buying from a dealer that you can also transfer this credit to the dealer.
I've posted the link to check for the final assembly. It's a constantly updated list, so
Yeah, the energy.gov, I think,
yes.
it publishes a list of qualifying cars, which the IRS will refer to as to which cars qualify. There was a transition point in 2022 when they passed the law. It was like mid-August, right? And so there was a provision that said if you ordered the car before the law changed, then you could potentially not be subject to the assembly requirements. I actually did have a client just last week send me a note that they received a letter from the IRS because they had purchased their car in October, and they thought that the car did not qualify for the credit because it was a BMW, but we were able to show that he actually ordered it in June, and I expect that credit will be allowed for that reason. There was also kind of a strange thing that Rivian took advantage of, where they had some people place orders, or they encouraged people to place orders right before the law changed in mid-August, but they didn't even deliver until 2023. But because of the way the law was written, then those buyers were able to amend their 2022 return and claim the $7,500 credit, even if their income was above the limit. So Rivian, I believe, are built in the United States anyways, and so the assembly point wasn't an issue. But yeah, so there was a little bit of complexity around the transition from the old rules to the new rules. And the old rules, of course, were also there was I think a 200,000 electric vehicle limit on the credit per manufacturer. So I think Toyota and Tesla ran into that before the law changed. There's now no limit per manufacturer, but there was income limits that didn't exist before. So, and of course, the new requirement for the assembly point. So. Any other questions?
Does the EV credit only apply if purchased from a dealer, no private transactions?
Yes.
That's all the questions. Thank you.
So right before our break, we'll break for a few minutes in a little bit. We are talking about 2025 tax law changes. Again, because of the gridlock in Congress, not much has changed so far for this year, with the Republicans taking control of the presidency in both houses of Congress. We may see some changes, but we don't know until we get there, right? So there'll be, I'm sure, plenty of activity in 2025 on a number of fronts, including taxes. So for now, just updated, the standard deductions now a nice even $15,000 for single filers, $30,000 for married filing joint, $22,500 for head of household filers. It's the easiest one to remember in memory. So now it's pretty easy. So HSA contributions are $4,300 for self-only coverage, or $8,550 for families. Gift limits, as mentioned before, have been increased to $19,000 per person per taxpayer per year, up from $18,000 in 2024. And retirement has increased another $500 for 401k 403bs to $23,500, up from $23,000 in 2024. IRA contribution limits have not changed. So with the catch-up contribution of $7,500 for 401k or 403b, you now have the ability to defer up to $31,000 in 2025 from your salary. So there are there's a provision of the Secure Act that I'm actually not positive when it takes effect. I may look it up during the break. That says that certain high earning employees may be required to make their catch-up contributions as a Roth after tax contribution rather than a pre-tax. I will try to look that up during the break too, because I don't remember which year that takes effect. I'm offhand. So there also are now options starting in 2024, if your plan supports it, to receive employer matching contributions as Roth rather than pre-tax. Currently, under the prior law, even if you were making after-tax Roth 401k contributions, any matching from the employer would still be pre-tax on a pre-tax basis, so that you would still have a pre-tax component of your 401k account, even if you were making solely Roth contributions. This has created a lot of chaos, I think, because of the way the IRS has come out and said you have to, I think the employer has to report their matching contributions on a Roth basis on the 1099-R, not as part of your W-2. And so not all companies are offering this yet, but I think will become more common as we move forward and people figure out the mechanics of it. So, any questions?
There's several.
Okay.
HSA for those who are employed only and does not apply to retired. It has to be earned into.
No,
Oh.
actually, you have to have a high deductible health plan, which actually don't remember the limit of right now, but most of the time an HSA eligible health plan will have HSA in the description of its name. You cannot contribute to an HSA if you're eligible for Medicare, right? And so generally speaking, once you hit 65 and are eligible for Medicare, you can't do HSAs, but I do have some people who retired early or independently financially stable, right? That have an HSA account they contribute to every year, even though they don't have any earned income. So that actually is not a requirement for the HSA. The only requirement is that you have the high deductible health plan.
Seniors, okay, there's a question about standard deduction for both married over 65.
So I believe that the addition is $1,900 per taxpayer who's over 65. And so you would add $3,800 for a married couple. It's about $33,800 would be the standard deduction for 2025. So.
Okay. There was a comment about qualified deductions being taxed as regular income, and there's also a response saying you have to check your 1099. Qualified or still.
What is this referring to?
Yeah, qualified dividends being taxed at long-term capital gains or as regular income.
Qualified dividends should still be taxed at the lower maximum rate for long-term capital gains. That has been around since George W. Bush. It's not part of the Tax Cuts and Jobs Act and is not slated to change as far as I'm aware.
Why does the IRS no longer tax on qualified dividends? If your income is low enough, is that the exemption?
Yes. I'm not sure what else that could be referring to. Yeah, if your tax bracket, to the extent that it's in the 10 and 15%, well, 15 doesn't even exist anymore, 10 and 12%, I believe, or under 20% tax brackets. Long-term capital gains and qualified dividends are taxed federally at 0%. California does not actually treat any different types of income differently and taxes them all the same. So I'm not sure that if that answers that question, maybe they can clarify. So
yeah, because it has to clarify if it doesn't answer yes.
Yeah. We have a few minutes before our break, so I think I'll skip to the next slide or two and then break if that's fine. So 2026 is Tax Armageddon, right? Taxmageddon, whatever you want to call it. I'm sure the media will assign all kinds of clever, at least in their minds, names to this. Almost all of the changes to individual tax law from 2017's Tax Cuts and Jobs Act expire at the end of 2025. Changes to corporate tax laws were generally permanent, but the individuals they had to let expire due to the way that they drafted and passed the law. They had limits as to how much they could increase the deficit, and therefore they had to expire most of these in the end of 2025. It's possible, perhaps even likely, that the new administration in Congress will move to extend some or all of these provisions, but we won't know until we get there. So just as a, and the next slide, I'm going to just list some of the things that are. I thought I had. Oh, apparently I got the slides out of order. I'm sorry. So these are some of the things that are potentially expiring from the Tax Cuts and Jobs Act that have been in place since 2018, right? Federal tax brackets revert to pre-Tax Cuts and Jobs Act levels, including top rate of 39.6 instead of 37 for the last several years. The increased standard deductions expire. The personal exemption deduction comes back. One of the things the Tax Cuts and Jobs Act had changed was that they eliminated the personal exemption deduction and increased the standard deduction in exchange. That simplified some things, right? But that may revert. The miscellaneous itemized deductions category will come back, including attorney fees on the production of taxable income. I think I'm looking at the wrong slide. I'm sorry. Oh, sorry. There we go. My apologies. Attorney fees, investment expenses like management fees, union dues, unreimbursed employee expenses, job search expenses, et cetera, right? So a lot of these things that people frequently ask me about, like, hey, I have to work from home and I have costs I'm not reimbursed for. These would potentially become deductible again as an itemized deduction. The caveat being they are an itemized deduction, meaning you have to itemize, and only amounts over 2% of your income as an aggregate are deductible. So the $10,000 limit on deductible state and local tax or SALT limit expires. Qualified business income deduction goes away. We mentioned that briefly before. Changes to the amount of income exempt from AMT, alternative minimum tax, expire, as will modified phase-out limits. The limit on deductible mortgage debt for your primary and secondary home reverts to $1 million. It's currently $750,000 since 2018, sorry. As well as the interest on up to $100,000 of mortgage debt not used to build, buy, or improve your home will be deductible again. Currently, the zero is deductible. Right? So this refers to if you take out money to pay off credit card debt, student loans, pay for vacations, do whatever, right? Anything that's not related to building, buying, or improving your home, the debt is not currently deductible, but up to $100,000 will be if the changes from the Tax Cuts and Jobs Act all expire. So. And the child tax credit will decrease from $2,000 per child to $1,000, and income limits will revert to TJCA. TCJA, I got that wrong, sorry, levels. And the $500 credit for other dependents will also expire because that didn't exist before that. So, and then the estate and gift tax exemptions will decrease, which I mentioned earlier in the presentation. Currently, it was $5.49 million in 2017. It'll be indexed for inflation, so it's expected to be around $6.5 to $7 million, I believe, if and when that time comes. So I think this is a good time to break for a few minutes, and then when we come back, we'll start talking about more exciting things about what we can do as we go into the end of 2024, and when you go into 2025, some things that we can look at. So, are there any questions left that I haven't answered?
No.
All right.
Russell, did you want to start up again?
Apologies for that unintentional screen share. I thought I was sharing just that window. Apparently I was sharing the desktop and didn't realize it. So thanks for stepping in, the people that notified me, and then for stepping in and sharing your own desktop instead. So apologies. On the break, I did take a chance to look up a couple of things, to confirm a couple of things that people were mentioning. One person had commented that you can make a qualified charitable distribution from an inherited IRA if the beneficiary is over 70.5 years old. That is correct. I apologize for what I said earlier was incorrect. There was also questions about the additional standard deduction for seniors over 65. I had said they were $1,900 per person. They are actually $1,600 per person, or $2,000 for an unmarried filer. So again, I apologize for getting that number wrong. And then was there one more thing? Oh, the year that the mandatory Roth catch-up contributions took effect was actually this year, but the IRS has introduced a transition rules, so that you have until 2026, the end of 2026 for the plants to start complying for that. And so I imagine that most, if not many, employers will have kicked that can down the road. So
And also
um,
there was a question about conversion of 529 to Roth, and it looks like that takes effect in 2026.
did it in 2026?
That's what I saw.
Huh. I thought it was this year. I could be wrong though.
I thought it said 2026. Uh, I
Huh,
could,
you could be right. So
I could also be wrong. I'm only as good
yeah,
as the
I mean,
web, which lies.
true. Yeah. So anyways, um, yeah, okay. So picking back up where we left off, which again, apparently I had this in the wrong order, and I apologize for showing this earlier. So we're going to spend the rest of our time, which is approximately an hour, going over year-end considerations. I will candidly tell you that my slide material is not enough to take up a whole hour, and it was not intended to be, because I expect that there'll be a lot of questions in this area. So as with the previous caveat that I'm going to avoid answering questions that have too many variables and are overly specific to your specific situation, your personal situation, in the interest of time and fairness. But if you have questions about what I'm bringing up or even other things, please feel free to bring them up. I'll do my best to answer them. So, do we have any other questions before I start?
My statement was wrong. I was referring to um, if you had to make your catch-up contributions to a Roth, and that's 2026. There is a question.
That's yeah. By the end of 2026 is when the employers have until the plans have to start requiring that. So,
Right.
and that's only for highly compensated employees, which seems to be employees that had a Social Security earnings of $145,000 or higher the prior year. So,
Kitty tax. Once a child has to file their own tax return due to capital gains, for example, must they always file their own return for all future years, or only in the years they hit the other conditions?
only in years where they have a filing requirement. So, um, correct. Yeah. So I believe this person is referring to there is a election that parents can make to include interest and dividend income for minor children or minor dependents on their tax return rather than filing a separate tax return for the child. But there is no ability to report capital gains on the personal return. I'm sorry, on the parent's return, which may, so if someone has stock sales in their uh, custodial accounts, right, or for minor children, then they may be required to file a tax return. But that does not trigger any automatic requirement to file going forward. It can be year by year. So
That was the only question that came in during the break.
okay. Um, so so we've talked a couple times about annual gift limits. So if you have not yet reached that and plan to, you can do that before the end of December. Make your $18,000 per taxpayer per recipient. And again, if you're a married couple donating to a married couple, that means you can do 4 times $18,000 and not have any reporting requirements or any impact on your estate lifetime gift or estate tax exemption. So you can always look at your flexible spending accounts or FSA funds if you're still working. I think typically the plans tend to give you until like around March to expend those for the prior year, but they are typically use it or lose it. And so if you don't either spend the money or get reimbursed for things that you already spent, you can um, lose the benefits, and in some cases, I believe, have the income added back to your taxable income for the next year. So it's like a double insult. You lose the money and still have to pay tax on it. I don't think that's super common, but it does happen. And so you can take a look at that. You want to review your current and planned contributions for your retirement and HSA contributions. And then you can always check to see if you've met your required minimum distribution requirement, especially if you have an inherited IRA that didn't have RMD set up, because up until this year, there was no enforcement of the RMD requirement on those accounts. So many custodians will just habitually send out a check on like December 1st if you haven't if they're not aware that you've met your minimum requirement distribution. The RMD is calculated across all accounts, but if you have multiple IRAs, then your custodian may not be aware of those other balances. So it is possible to meet your RMD for one account by taking a distribution from another account. But again, if you set up your account to automatically issue the RMD, then you may still get a check if you don't let them know that you've already met that requirement. So.
And isn't the RMD requirement by each account type, inherited IRA, regular IRA, 401k?
So the RMD for a inherited IRA will be based on the age of the decedent, right? The person who died and owned the account originally. The RMD requirement for 401ks and IRAs, I believe, are the same because they're based on your age. So.
Right, but you can't take the RMD for a 401k from an IRA.
I believe that's correct. Sorry. Yes, thanks for clarifying that. So one thing I like to educate clients on is the underpayment penalties because they're often not understood. And for many years, they weren't that substantial. So people didn't pay that much attention to them, right? It is an interest-based penalty, and meaning that because the interest has increased, the cost has increased. For many years it was 3.5%. You might get a couple dollars here, a couple $100 there, and people would just pay it and not pay attention to it. Now interest is 8%, and so they've become much more painful, and people are becoming a little bit more. They're paying more attention to them, right? So, in short, we do have a pay-as-you-go system. And the penalties can apply if you do not pay enough during the year through withholding or estimated tax payments, right? So because we don't know what your tax is going to be until we file the return, we can make a really educated guess, but we're not going to know the exact numbers until we actually prepare the return. And so there is some safe harbor built into this penalty, which is the lesser of 90% of your 2024 tax or 110% of your 2023 tax. I say 110% because for most people attending this, it probably applies. It is 100% of your 2023 tax if your adjusted gross income is less than $150,000, 110% if it is above that, right? And so if you meet this threshold, then even if you owe more money, as long as you pay it by April 15th or whenever they extend the deadline to, as the case may be, then you won't be subject to this penalty when you file, right? So California has similar rules, except that if your income's more than $1 million, the only safe harbor threshold is 90% of your current year's tax. They do not allow you to use the 110% of prior year as a safe harbor once you hit $1 million of income. So, as I mentioned before, underpayment penalties are interest-based and currently 8% for the IRS and 8% for California. These are assessed daily. So if you missed one or more estimated payments or your withholding is too low, the earlier you meet your safe harbor requirement, the smaller the penalties are, right? And the other thing to understand is that by default, the agencies are going to assume that your income is earned evenly throughout the year when they calculate this penalty. However, you can use a longer form for the penalty to tell them that no, the income was earned unequally through the year. And so, for instance, if your income, like if you had a very large capital gain in this month, right, then it would be inappropriate to be assessing an underpayment penalty for months before this, right? And then that can sometimes lower the amount of penalty. If you use a preparer, then just be aware that almost none of them will actually do this unless you ask them to, right? And some of them may charge an additional fee for the additional work. It is a lot of extra work to try and refigure it in some cases. And so I always ask clients if they're subject to underpayment penalties, whether they want to look at reconfiguring it or recalculating it. But as far as I'm aware, I'm pretty much the only one that does that automatically anyways. So, one I mentioned, I'm sorry, it triggered me that I didn't, when I was writing this, last year in California, like January 13th of 2023, right? There was a huge storm and almost the entire state was declared a disaster area. and the IRS said, okay, you have until May 15th to file and pay for 22, and any estimated payments for 23. That later got extended to October 15th, and then it actually got extended to November 16th, right? California said no more of that, right? Because up until recently, California had a policy of automatically matching whatever the IRS did. That put them in too much pain last year because they didn't collect a lot of tax until November or October instead of in April when they're supposed to, as well as the estimated payments for 23 were all deferred until November, the due date. And so they've now decoupled from that. And therefore, if there's a future disaster in the state of California, the California will not necessarily automatically just match whatever the IRS says. The IRS never really gave any rationale for why they made that decision, especially the decision to extend it to November 16th, which they didn't let us know until about noon on October 15th, which was the normal due date of extended returns. And so a lot of people had already filed and were made payments for, as needed, and didn't realize they were going to have another 30 days. So it was kind of arbitrary as far as I could tell. So anyways, any questions?
Yes. What about tax considerations? Tail shouldn't in general wag the dog. What about the case where someone's main asset and income is a set of assets, diversified mutual funds with very low cost basis? Any sale of the asset realizes a capital gain of almost 90%. After taxation of such gains, there's a significantly lower asset base on which to live, develop further capital growth. What means are there to avoid or defer capital gains realization? Or is a person locked in with that portfolio and just needs to sell off assets to meet current expenses?
You don't have a whole lot of flexibility on that, unfortunately. You either hold it until you die and get a reset tax basis for your heirs, really, or in a community property state when the first spouse dies, or you have to sell and pay the tax. And so there's not a lot of ways to avoid tax on capital gains that don't involve reinvesting that money. And if the question was that they're selling it to pay for their expenses, that's not going to really help them, right? Because just like we talked about earlier, that if you reinvest something to avoid $10,000 of gain, you're not going to have that money, and you're going to save 15 or 20% of that, right? So plus state tax, there's another 9.3% most likely in California. So unfortunately, there's not really much option there other than to try and hold off selling as much as possible until you get a basis reset upon passing away. So, which doesn't help you, but will help your heirs. So,
if your calculation is that you have underpaid taxes during the year, can you send a check before April 15th to prevent the underpayment penalty?
Yes, at least from that point, from that date forward. Yes. So the underpayment penalty does get calculated through April 15th of next year, which is the due date, or I actually haven't looked at the calendar, I'd be 16th or 17th, whatever, right? And so, yes, there is, it's actually the same interest that you pay for a late payment, right? And so they're telling you that you paid your taxes late because you didn't pay them enough of them early throughout the year, right? And so the calculation runs through the due date of your return and the tax payments, which is mid-April somewhere, right? And therefore, yes, if you realize in February that you underpaid and have this penalty, if you pay it in February instead of April, you'll at least save that 8% on the underpaid tax for February through April 15th. So.
For paying tax from withholding, does this underpayment still apply?
Yes. However, there is actually a special rule. I'm glad you brought that up because I didn't. That taxes withheld from your paycheck or retirement distributions or other sources are generally considered withheld equally throughout the year, even if they're done later in the year, right? So if you have an RMD that you have to take at the end of December, and you are underpaid throughout the year, if you have taxes withheld from that, it's going to credit you making those withholding ratably throughout 2024, even though it was taken at the end of the year. So that can be one way to minimize or avoid this tax. So, or if you are still employed and have paychecks, you can always increase your withholding as you go into the end of the year to, again, try and first of all, minimize the underpayment, right? But also then minimize the underpayment penalties. So.
Yeah, I heard of one game where if you realize it before the end of the year, you could take a distribution, have it withheld, and then pay back the distribution. Sneaky, but
Interesting.
could work once
No, I
every
guess I
other
could see
year.
that, so if you're doing like, if you're treating this indirect IRA rollover and redepositing the funds within 60 days, then yeah, sure, you could potentially take that distribution, even if it's early, have taxes withheld, and then use other money to put that money back in, including the money that was withheld, right? Um, and then it would be treated as withheld throughout the year, and you wouldn't have to pay tax on the IRA distribution if it was redeposited within 60 days, right? So I've not heard of that, but that makes a lot of sense. It seems like for most people, it may not be worth the trouble, um, because you also would be foregoing any income or growth in the account on that money while it's outside of your account. So, but yeah, that could be an interesting strategy. So, and now
Is
that
there
the rates are 8% instead of 3%, the stakes are a lot higher. So, I could see that would be a little bit more worth considering now than it was a couple of years ago. So,
is there a minimum amount in a IRA which does not require a RMD, such as a
no,
balanceable? No. That was a quick answer. Has
not that I'm
any
aware of, anyways. So,
has any thought been given to K1 cutoff date prior to September 30th?
I mean, when the partnerships have to send it to you by,
Yeah,
no, I don't believe so. The reason that it's September 30th is because the extended due date for calendar year partnership returns is and S corp returns is September 15th, right? And so, no, I don't think there's any. It used to actually be October 15th, but that caused a lot of chaos and problems for the reason that you're just mentioning, is that you may not get the K1 until if the partnership or entity um, waits until the last minute to finalize the return, right? And so they did many years ago or several years ago move that due date back a month to allow for a little bit more time. So you have at least between September 15th and October 15th to finalize returns. I do have some clients that have a huge number of K1s. That this is a big problem for us as we go into crunch time for the um, extension season. I have one client that's 160 K1s that didn't come until September 15th this year. So that was fun. So
at least there's less modified 1099s being issued.
well, that's a separate thing because the 1099 is not a K1. They're talking about a K1, which is the
Yeah,
mechanism that
that's
the
true.
pass-through entity, such as the LLC or S corporation, pass the owners or partners share of the taxable income of the entity through. So, yeah. So there is, I'm sure almost everybody in this audience has already experienced that. The general deadline for people or for agencies and institutions and employers to send out 1099s and W-2s, et cetera, is January 31st of each year. But that brokerage accounts end up getting until February 15th, right? And so usually most of my clients aren't ready to file until mid-February because they're waiting for these statements. And the reason that the IRS gives them that extra time is because it does, in theory, result in fewer corrected 1099s. There are certain calculations that the brokerages can't do necessarily by January 31st, such as wash sales for things that were sold if you sold a security at a loss in December and repurchased in January, right? They may not have already done that calculation to limit, to record that. Or qualified dividends also involve a holding period for of 60 days starting before and after you own the stock, right, or the date of the dividend rather. And so sometimes, if you buy a stock at the beginning of December, they may not know whether it's qualified or not in a dividend that's paid out that month until January, right? And then the other thing that's common is foreign tax credit, because not many countries in the world use a calendar system, a calendar tax year like the United States does. The imperial the British colonies, they usually use a April to March tax year. I think like Australia uses July to June, right? And so trying to figure out what the calendar year of foreign tax can be on the mutual funds that hold foreign investments can be a little tricky and take extra time. And so it used to be very common, or at least more common, that the brokerages would issue one or sometimes even multiple corrected 1099s throughout the filing season. And so even today, even with that delayed due date for the 1099, I often will counsel clients that have significant dividend and investment income to, even if we finalize the return early in the season, but to hold off on filing it until April, just in case there's an amended 1099 or something comes out, because it's much easier to adjust before you file than have to amend the return later. So.
Okay, that was all of the questions.
Okay. So just as a simplified, grossly simplified example of how an underpayment penalty is calculated, I will tell you candidly that this calculation is not correct, and it was simplified just for an example, right? So if this taxpayer had a tax for 2023, $100,000, and their total tax for this year is $125,000, they made estimated payments of $50,000, and therefore their safe harbor is 110,000, which is 110% of 100K, or actually 90% of 125,000 is a little bit higher than 110. So we use the smaller, right? And so they've underpaid by $60,000, right? And so again, this is overly simplified, but this just shows that this is the number of days between the due date and when it was paid. And so the first quarterly estimated payment was due on April 15th of 2024, and we're assuming she's paying it on September 15th of 2025, and therefore 366 days have gone by, right? And so for $15,000, that's a $1,200 penalty. And then she also has another $15,000 underpaid from the second quarter, which is 304 days, 999, et cetera, right? The actual calculation when I ran it was really close to about $2,200 or $2,300. I didn't feel like it was necessary for me to really go into as much complexity in order to find out why it was that different, et cetera. So just to kind of show you, though, that it is an interest-based penalty by the number of days that the payment is late, right, or underpaid. And so, that's just kind of to show that there's some real money involved now. You know, this is, I think, roughly 5% of the $60,000, you know, overall. But yeah, but like, you know, but it also shows you that if, you know, a lot of this tax came because of a stock liquidation or income event that was in the fourth quarter only, then maybe that these numbers for the first three quarters would be smaller, right? On the other hand, if the big income event was in the first quarter, then it actually benefits her to treat it as if the tax was equally throughout the year. And so it, you know, sometimes it's worth looking at, you know, for many of my clients, you know, I'm Silicon Valley tax coach, therefore I, you know, practice in San Jose. A lot of my clients are tech workers. They get withheld on bonuses and equity compensation, and a lot of them have to pay these penalties every year, right? And for them, it's just kind of a fact of life, where they have to pay a lot of money in April, and then they get this other calculation coming in from the IRS and state later saying, you know, by the way, you underpaid, and here's some more penalties. But, you know, we can plan around them and plan to avoid them or minimize them with a little bit of foresight. So. Any questions about this?
There appears to be a question about a Roth that I missed, and while I'm looking for that, the delay in brokerage statements will increase the 8% penalty for the delay.
Possibly, yes. I mean, so I think that they're saying like, hey, if we don't get the brokerage statement until mid-February, we may not know how much tax we owe and therefore how much tax we underpaid until mid-February. That's possible, yeah. You can always make an estimate if you're concerned about that. But I mean, the fact of the matter is, if you have cash in the bank, you're not earning 8% on it. I mean, the best I've seen is around 5.5 on a liquid account, right? And so, and that's probably going, will start going down if the interest rates start going down, right? And so, you know, if you have cash to pay your taxes and are just sitting on it for liquidity purposes, you're losing potentially money, at least up to the point where you have to meet your safe harbor, right? And then, you know, once you've hit your safe harbor, by all means, keep your cash and earn that, you know, 4 or 5% on it. That's, you know, and then have the money, your tax payment, you know, directly debited from your savings account, so you get interest to the last second. I mean, that's, there's nothing wrong with that. But a lot of times people pay this tax or this penalty because they don't know what they have to pay, right? And so, and unfortunately, the withholding, for the withholding calculation form W-4 is terrible, right? It's like if you have a very extremely simple situation where you have like almost no other income and just one job, then it can probably get you the right answer, and short of that, probably not, right? And then they made it even more complex several years ago after the Tax Cuts and Jobs Act was passed, sorry. And so it's very hard to get the right amount of withholding. I mentioned briefly the equity compensation under withholding. If you get paid a bonus, the IRS actually requires your employer to withhold tax at 22%, even if your income puts you at the 37% tax bracket, right? Up until $1 million of compensation, right? So from $0 to $1 million, if you get a bonus, a commission, or have RSUs vesting that have income, they're going to withhold at 22%, right? And even though the 37% tax bracket starts at, I don't know, $400,000 or $500,000. So above 1 million, they require 37% withholding, which would be correct, right? So, a lot of people pay these penalties and they've not done anything wrong, right? All they did was follow the calculation, and their employees are following the rules. Some employers are starting to allow employees to opt for a higher level of withholding when it comes to RSU vesting, like Apple and Airbnb, and I believe Google now does as well. Maybe Facebook, I don't remember offhand. So, but not every employer allows for that. And so clients that have, I get these W-2s that have a couple $100,000 of wages on there, some has several $100,000 of wages. Oftentimes, half of them or more are from equity compensation that are under withheld at 22% instead of, 30, 35%, 37% that they're actually being taxed at. So it's kind of a shame. So I try to make sure that people are aware of how these work. And also, oftentimes when a new prospect or client comes to me, no one's ever actually explained to them that 22% mandatory withholding rate on equity compensation, bonuses, commissions, et cetera. So, and honestly, I think that the rationale behind that fixed withholding rate is because people would tend to change their withholding before they got a big commission, say, in order to not have too much tax withheld, right? And then forget to change it back, and then they'd end up underpaying or whatever. And so, and it's also important to understand that these type of payments, the equity compensation and salaries or bonuses, commissions, they're all taxed the same way. The only thing that changes is how they calculate the withholding on that income. And so even if you change your withholding on that, it doesn't change the actual amount of tax that is withheld. It only changes the amount, the tax that's paid, only the amount of tax that's withheld. And in that case, it won't actually change it at all. So any questions?
Is there a safe harbor for CA state taxes?
Yes. So again, it is the same as the IRS. I think California has similar rules, except that if your income is over $1 million, your only safe harbor is 90% of the current year's tax. Otherwise, you have the 110% of last year as the option. So if your income is much higher this year than last year, then the 110% of last year figure will probably be much lower, right? And even if a lot of your income is coming from W-2 and a lot of it's coming from equity compensation, even with lowered withholding on those amounts, you could still meet that 110% threshold just by accident, right? But if your income is lower than last year, then you might want to look at 90%. The unfortunate thing is that 90% of this year is a moving target. We don't know what it's going to be until we prepare the return, right? Whereas 110% of last year, that's a fixed number. We know that once your 23 return is prepared and filed, right? And so, yeah. So again, this is an area of interest for me. Like I like to make sure that clients understand and people understand how these work so they can make an informed decision about making extra tax payments earlier and what the trade-off is. I always tell people, if you choose not to make estimated payments, that's fine, right? But I at least want that to be a choice, right? And not just the default because you don't realize that you're underpaying and this is what it's going to cost you, right? So because anyone can always look at it and say, well, 8%, I can probably do better than that on my investments. I'll just liquidate them later on. That's totally fine, right? That's an investment decision that you're making of how to deploy your assets, right? And when. And that can be that I don't have any problem with that choice as long as, like I said, it's actually a choice. So
There was one
Loss
question.
harvesting, I don't, go ahead.
Sorry, continue. I'm looking for a question. Go ahead.
Okay. Loss harvesting is not a concept that's foreign to most of you, I'm sure, but just to kind of review it, the capital losses are netted at three levels, right? When they're for tax purposes, you have short-term gains and losses are netted, so you have a net short-term gain or loss. You have long-term gains and losses are netted for net long-term gain or loss, and then those two numbers are netted together to give you an overall taxable gain or loss, right? And so you can reduce taxes on long-term gains with short-term losses and vice versa, right? And so oftentimes investors, as they go into the end of the year, will look for positions that are in a loss position in order to, and maybe to consider liquidating those in order to generate capital losses to offset gains from earlier. Most of you will also be well aware that mutual fund and EFTs tend to distribute capital gains in December, mid-December, right? And large dividends and capital gains can be paid out in December, and so that can also be part of that calculation for yourself, whether it makes sense to harvest some losses or not, right? So I don't know if there's any question about this. Is pretty basic stuff. I think that, again, anyone in this webinar that's interested in investments will probably be well aware of this, and but I didn't want to just mention it. So there's a lot of misunderstanding about wash sale rules. There are a lot of people who are very panicked about this, and it can be a significant factor of how much of your gain or loss is taxable or deductible, right? So a wash sale happens when you sell an investment at a loss and then acquire an identical or substantially identical investment within the next 30 days. What happens is that the loss from the initial sale will be deferred and added to the basis of your new investment, right? It means you don't lose the loss, you just don't get to deduct it until you sell that replacement transaction, and don't incur another wash sale when you do that, right? So if you buy something for $100 and sell it for $50, you have a $50 loss, and then you buy it again at $60, your basis is now $110 of the net of the new investment, and you do not get to deduct the $50 capital loss from the first sale, right? So now when you sell that one, your basis is $110, which is the $60 you paid plus the $50 loss that you didn't get to take, right? So to avoid wash sale impacting your overall gain or loss, you need to make sure that you either don't repurchase the investment within 30 days, or that you sell the replacement before the end of the calendar year, right? And then again, don't repurchase it within 30 days. So with a little bit of planning and awareness, this can be mitigated. Where this has started to become a little bit more of a nightmare, unfortunately, is with certain companies that have like RSUs vesting, where Airbnb was the one that I run into recently that has kind of a nightmare where their employees are vesting shares each month, and so they are in effect purchasing for wash sale purposes a new share each month, new shares each month, and it becomes a nightmare very quickly. So and then at the same time, there's no way for the employees to avoid it because they only have certain time frames with which they can sell stock. And so it's impossible to time it so that it doesn't hit it. So that's been kind of an ongoing headache for those clients and for me, frankly. So, but it's relatively niche, that particular issue. So
One question. If you
any
have
questions?
one question. If you have excess short-term capital gains, capital losses, can you choose not to net them against long-term capital gains this year and save them for short-term gains the following year?
No, unfortunately not. I see what you're trying to do, because the short-term capital loss a short-term capital gain in a future year will have a higher tax rate than a long-term gain this year, right? And
Yes.
so in general. And so I understand that question of what you're trying to accomplish, but unfortunately, no, there's no election to not net those amounts together.
Is selling a put for XYZ within 30 days of the sale of XYZ trigger a wash sale rule as the put is considered substantially the same?
I think only if it has the same date. An option expires at the same expiration date. I'm not 110% sure of that though. So if someone knows differently, please let me know or let us know. So
Okay, thank you.
I also don't know offhand whether selling a stock at a loss and then buying an option for that same stock would trigger a wash loss. I don't know that offhand in case that's something that someone is asking is wondering about. So we have about 25 minutes left. And I have a couple more slides. So keep the questions coming as you have them. So year-end donations can be considered, right? You look at the charities that you wish to support and how much you wish to give them, and then decide whether you're going to make a donation at the end of the year, right? You can always look at the qualified charitable distribution. You can look at a donor advised fund, which someone had asked about before. You can consider donating appreciated stock or other assets in lieu of cash, because you still get a full deduction of its value without paying tax on the gain, right? So if you have like this other person that had asked, they said they have 90% appreciation in their mutual funds. If they wanted to make a donation, which may or may not be the case, but if they wanted to, then they could potentially take some of those mutual fund shares and donate them, get a full fair market value deduction for the donation without having to pay tax on that 90% appreciation, right? And so many of the larger charities are perfectly happy to accept stock in lieu of cash. Those that are smaller and may not be equipped to do that, then the donor advised fund can be used. The donor advised fund is a charitable trust that the stock brokerages typically maintain. Schwab has one, Vanguard has one, Fidelity has one, et cetera, right? Where you can contribute those stocks or cash to them, and then take the deduction in the year of the donation, and then you can distribute that money to charities over time, right? So that it is a way to take a larger deduction in a year of a high income event, such as you retired or did a Roth conversion or sold your house or whatever, and then still distribute that money to the charities on the schedule that they're accustomed to. Because I find that most charities that get a very large deduction or donation in 1 year will ask for that same deduction the next year, right? And so that can help you concentrate the gain where it's most useful for you, and also but still distributing the funds over time as you wish. So and also again, the donor advised funds will all take stock donations, even if the charities you want to donate to aren't equipped to handle that, so that you could donate the stock to the donor advised fund and then send cash to the charity without having to sell the stock. So qualified charitable distributions, we've talked about a couple times. So one thing actually I want to mention is that the brokerages do not, the institutions that issue the 1099-Rs do not indicate a qualified charitable distribution anywhere, right? And so you need to make sure that you are accounting for those if you're preparing your own return, and if someone else is preparing your return, you need to make sure they know if you've made these qualified charitable distributions from an IRA, so that they can properly report them on your tax return, or rather not report them as income, as the case may be. So
QCDs are effective the year that the charity receives the funds, correct? And if they don't cash the check, you have a problem?
I've never run into that, so I don't know. Usually a donation is deductible in the year that you sent the money, not when the check is cashed. So even if you're making a credit card donation on December 31st and the charge doesn't actually clear until the 2nd or 3rd of January, you're still considered to have made that donation in December. So I would imagine that, or even if you mailed a check in December and it wasn't cashed until the next one. So I don't know that would be a problem, but I've not run into that specific scenario. So
there was a question about energy credits for batteries to solar panel installations. You covered EVs, but I don't believe you covered solar credits.
I did not. Sorry. Was there a specific question about it?
That just generic, adding batteries to a solar panel or adding panels to a solar installation.
Okay, so you didn't miss it. I apologize. That is something I did not cover. It was a choice just because it's not a huge. Okay, sorry. The energy efficiency improvement credit is not enormous. It's $1,200 per year, and there's quite a lot of detail as to what qualifies. The solar and battery credit of 30% is much more straightforward. Perhaps I should have included a slide on that. So if you are adding a battery or panel to an existing solar array, then solar system, then the costs do qualify. If you're installing the new system, then you get 30% of the installed cost. I will caution that I don't know if it's quite as prevalent as it used to be, but for a while there was a lot of solar salespeople that were telling their customers that if they had to redo their roof in order to support the weight of the solar array, that the entire cost of the roof was also creditable. That's not true. So, if you can identify a specific cost that is directly related to the installation, like the square foot underneath the solar array footprint, perhaps, but short of that, no. And I think I've been hearing less of that lately in the last couple of years, but for a while, solar salespeople were like the bane of our existence in the tax realm. So actually had even a very funny story of someone trying to sell this credit to like one of the most well-known tax instructors in the country, and arguing with him about how the deduction worked. And he's like, no, I know this. So
Okay, there's also a question about Form E rental real estate income as QBI. What are the rules? There's 2 rental houses involved.
okay, I'm going to go back to the last question. There's one more detail that I didn't mention.
Oh, sorry.
The year that you get permission to operate, or PTE or PTO, that's when you get to the credit, right? So especially at this time of year, if you start a project now but doesn't get turned on until January or beyond, then you would not be you would get the credit in the year that you get the PTO, right?
Even though they
from the
charge what,
utilities.
even though you're paying for the equipment when it's delivered, not when it is
Yes.
activated? Oh,
Yep. It's considered placed in service for the credit purpose when you
okay.
are able to turn it on, and you get the permission to operate from the utility. So most of the
Right.
year, that's not really a consideration, but if you're starting one at this time of year, then it may be. Right?
Our solar goes in Thursday.
Hopefully it gets turned on before December 31st. Honestly, I don't think that it usually takes that long. I had installed a battery at my home like during the pandemic, and so like we got delayed. Our PTO got delayed from like February to like May because the city inspectors weren't coming out and permitting it, right? That wasn't a problem though, because it's still within the same calendar year. But I think ordinarily, it's not usually that much of a delay to get it approved. So the question
credit,
about claiming
well,
rental real estate income as QBI.
Yeah.
Sorry.
Okay, I need to get back to that. There was also a detail, Richard was asking additional credit for adding panels to an already operating system. Credit was installed. It sounds like the credit applies if
On the
you're
additional
adding
costs. Yes.
additional cost when it's authorized for use, right?
Yes, exactly. Yeah. I
So
did
I'm
mention
looking,
that, but that's fine. So
okay, please discuss the
so there
rule.
was a question about the QBI, I believe, for rental.
Yes, please
Um,
just go ahead.
Generally speaking, qualified business income is generated from a rental real estate. It's pretty unlikely that most investments would not qualify. The bar is fairly low. It has to be an investment that you entered into for the purpose of making money, right? Has to have a for-profit motive, and that you are at least nominally you or someone, an agent that you appoint, are involved in running it, right, and making management decisions. So the only time you'd really generally see a rental property that's not QBI if it's like triple net and you have nothing to do with it, right? So if you or a manager that you hire isn't actually like running the property, then maybe you have a question about it, right? So there is some confusion that arises because the IRS, short like a year after TCJA passed, came out with a safe harbor that's like preposterous, right? And it's very strict, like 250-hour requirement that you have to spend on the property, and you have to document it very extensively. But the actual bar is much, much lower than that safe harbor. So they're saying if you meet that safe harbor requirement, they're not going to question whether it's qualified business income. But it's very ridiculous. I've never heard of a single person actually using the safe harbor because the regular threshold to actually qualify as qualified business income is so much easier. I have, however, seen investors that come to me as new clients whose prior preparer claimed that it wasn't QBI because it didn't meet those safe harbor requirements. And we're able to catch that and have the other preparer amend those returns and claim the QBI deduction. So yeah, I guess there's some different opinions on it, but there's only one that's correct, right? And that is that almost all rental properties that you are renting out for purpose of a profit and making money are going to qualify as qualified business income in practice. So if you own a property that you're renting to a family member at below market value, no, right? I mean, you're probably losing money on that anyways, right? So it's not generating positive taxable income regardless. So.
Okay, so there's several questions. Do you have more slides, or do you want to wrap up, or should I finish with the
There
question?
are a few more slides, yes.
So which would you prefer?
Either if there's questions, I can answer them.
Okay, what do you recommend for estimated tax payments if you're executing a Roth IRA conversion in December of 24?
So if you're factoring the timing of your income event, the Roth IRA conversion, then the estimated payment would be due on January 15th. So the estimated, actually, I don't think I actually said that. The due dates are April 15th, June 15th, September 15th, and January 15th. So they're kind of quarters, right? Because the second quarter is only 2 months, right? And those are going to cover the period that ends in the month prior. So for April 15th, you're supposed to pay tax on income that was earned through March 31st. For June 15th, it's May 31st. For September 15th, it's August 31st. And January 15th is December 31st. And so if you have a large income event in December, you have until January 15th to make that estimated payment. And you would only owe any underpayment penalty that may apply on after that date.
If an owner passes, how does the beneficiary or executor determine and document the value of the asset cost basis that has been stepped up at time of passing? Stocks, bonds, property, art?
Publicly traded stocks and bonds, fairly straightforward. You just look at the value on the date of death, right? Sometimes you just use the closing price. If there's a big difference between the opening and closing day for the day, you can always use an average, a high-low method, right? Property, art, got to have it appraised. Sorry, there is an exemption. There is an exception where if you sell something within 6 months of death, you can generally presume that you sold it at fair market value at the time of death. So because most assets don't significantly change in value within 6 months, is what the IRS position is anyways.
And that's
so
for
if they sell a home, if they leave a home behind and it's sold within 6 months, then you may not necessarily need to have it appraised. You may want to anyways, just to know what the actual value was in case it went down. So
that doesn't apply to stocks or bonds, right?
no, because those are readily ascertainable, right? And also much more volatile. So, but if you have something like a collection or an art piece or a piece of real estate and you're selling it fairly quickly, I think you can generally treat it as if the price you sold it for within 6 months of passing is the fair market value at date of death.
Can you pay 110% of 2023 tax in December and still meet safe harbor for 2024?
For the fourth quarter, yes. For the rest of the quarters, no. Unless your income was not equally throughout the year, right? So, but again, it is an interest-based penalty calculated by the day. So even if you've underpaid for the first 3 quarters and you want to make that payment now, you're still better off doing that than waiting until April, because you're not going to have the underpayment penalty for the time between now and April 15th. So
This is a comment from Lynn that my experience is that the QCD check must be cashed by the charity in the tax year or it cannot be used in that year. They verify the date the check was cashed through my brokerage firm before the end of the year.
Interesting. No one's come to me with that question, or I've never asked that question to my clients before. So that's probably valid. So thank you, Lynn.
For paying taxes from withholding, does underpayment, okay, there's been responses that even if basically, as you've already said, if you're paying from withholding, you can still get hit from an underpayment penalty if you haven't withheld enough.
Exactly. But the actual taxes withheld are paid are treated as paid equally throughout the year. So the underpayment penalty won't apply to those payments, but you can still be underpaid, like she just said. So
say on an average 40-hour work week, what percentage of your time can be deducted to charity? Say if you work for American Red Cross, help to donate blood and not get paid. Can you donate your time since American Red Cross is a charity organization?
as a professional, it pains me to say this, but your time is worth nothing unless someone's actually paying you for it. So you do not get a deduction for time donated to organizations. Just that warm, fuzzy feeling in your heart, knowing that you're making a difference and helping people.
So, okay, one more question. About from Lynn's comment is your comment is correct. If you write the check yourself, however, you let the brokerage cash cut the check will be shown in the year the check was cut. I'm
possible. Yeah. My understanding is a lot of brokers will not mail the check to the charity. They'll mail it to you, made out to the charity, and then you have to mail it. So there can be potentially, I could see there could be some potential for misalignment. So
I don't understand the last statement. CA and Fed tax issues with ADUs that some cities are promoting. I'm not
yeah, I would
certain.
need some clarification on what's actually being asked. And so please clarify, and then we'll answer that in a little bit.
Okay, that's all the questions I see.
Many taxpayers run into passive loss limits. I frequently get prospects and clients asking if they can save taxes by investing in a real estate. Generally, the answer is no. Back in 1986, when the Reagan administration and its Congress reformed the tax law, they put limits on passive losses because too many people were buying real estate, taking a very large depreciation deduction and using that to offset income, the loss to offset income from other sources, right? And so generally speaking, all rental income is passive in nature by law, and passive losses can generally only be used to offset income from other passive sources, right? So, and so that is, yeah. So when people say like, oh, can you show a loss from a rental income property? Yes, after depreciation. But will it be used to offset income from other sources such as a W-2, interest, dividends, capital gains? Generally not, right? The exception for this is that passive losses that are limited, that get carried forward, they get tracked by the investment, per investment. And if you sell that investment, then you will generally be able to deduct the losses that were associated with that investment in that year, right? The other thing is that any gain from the sale of a passive loss is considered passive income and can be offset with accumulated passive losses from any source, right? And so, unfortunately, you have clients that have very large real estate portfolios. They often will have significant passive loss carry forwards that they don't really get to utilize. But the depreciation from these properties does still shelter the rental income from tax. It is still a tax advantaged, still is considered a tax advantaged investment overall, assuming that that's something you want to invest in. And you do eventually get a step up in basis once the owner passes away, which can also be very powerful. So if you have passive losses that are suspended, you may look for what they call a PEG, a passive income generator. Sometimes you'll find a passive partnership or other business investment that will generate high income, for you that you could offset against passive losses. That can be a strategy to use if you can find one. So,
Okay,
yeah.
thank you.
So because then that new investment would generate income that's not being taxed currently. So there are exceptions, right? So right now, especially in 2023 and 2024, there's been a lot of buzz about short-term rentals as a loophole, so to speak, for this. It is, with some significant caveats that aren't typically discussed on social media. So I want to just kind of briefly go over what those are. So short-term rentals are rental properties that have an average guest stay of 7 nights or fewer. That means that you take the number of nights that you rented the property divided by the number of guests, or the bookings, right? If it's less than 7, it's short term. If it's more than 7, it's not short term. Short term rentals are not passive, right? They are considered active, although most of them are not considered self-employment income unless it's an actual hotel, motel, bread and breakfast type of bed and breakfast type of facility, right? If it's an actual host business, right? And the other thing to remember is that even short-term rentals always go on Schedule E, not C. I see a lot of returns for some reason where people think that if the short-term rental has to be on Schedule C, no. If it is in an LLC, it has to go on Schedule C, no. Also no, right? And so rental properties that do not provide substantial services and are therefore subject to self-employment tax on any profits always go on Schedule E, whether they're passive or not. So just kind of a pet peeve for people that do a lot of this type of planning. So there's two parts to this short-term rental loophole. One is the short-term rental, right? The 7 nights or fewer. The other part is that you must also materially participate in the activity in order to deduct a loss from that short-term rental, right? There are actually 7 different tests to qualify as materially participating in a property. And as long as you meet any one of them, you are considered materially participating, and you can deduct that loss against other types of income because it's not passive, right? For a joint return, either or both spouses' time can be factored for material participation tests. The lowest bar for material participation is usually that you spent at least 100 hours documented and recorded on the activity, and no one else spent any more time than you on the property. So if you are hiring a manager to manage the property, you will probably not meet that specific criteria, but there are 6 others you can look to see if you can qualify. If you're looking for a short-term rental investment that you plan to close before the end of the year, if you can jam in 100 hours of material participation or more, then you could potentially use this loophole even if you hire a manager in 2025, right? Sometimes it takes quite a lot of time and involvement to close the deal, furnish it, get it listed, market it, etc., and start having guests stay before the end of the year. Time's tight, but it's possible. I did have a client last year who purchased a condo in Pismo Beach in early December, managed to get his 100 hours in, and was able to claim a loss from his against his other income. So the other exception is the real estate professional status, or REPS, allows an investor to disregard passive loss limitations with regard to real estate investment income, right? And so this is another thing that has a lot of very specific and detailed requirements to qualify for. And one of the main ones that people run afoul of is that more than half of your time spent working in the year on income producing activities must be spent working on real estate investments or businesses, right? And that means that if you have a full-time job that's not in real estate, you do not qualify. I don't think I've ever heard of anyone that is able to qualify for that, because that means you'd have to spend more than 2,080 hours, assuming you only work 40 hours a week, which in this valley is not that common, right? You'd have to spend 2,081 hours per year doing real estate in order to qualify as a real estate professional. So if you're a real estate agent, broker, developer, wholesaler, flipper, property manager, then that time will count as a real estate business. Other than that, you're not going to generally be qualified as a real estate professional. However, if you have a spouse that doesn't work, they might be able to qualify as long as they meet the criteria, right? So we'll make one clarification, is that I put on the first half of the slide for material participation. Either spouse's time can be counted for calculating whether, or determining whether material participation was had, but for a real estate professional, only that spouse's time counts. So, any questions?
Yes, if you're over the standard deduction and buy a computer system that'll be used for many years, such as computer, must you take the depreciation deduction over the life of that product, or can it be expensed in that year and carry over the expense to offset income over a number of years?
There are provisions to accelerate depreciation and take more of it in the first year than is normally calculated. Commonly, we use what we call bonus depreciation, which for the last many years has been 100% of the purchase price. It did go down to 80% in 2023, 60% in 2024. The law I mentioned that was passed at in January of this year that never made it out of the Senate was planning to, one of the provisions was to retroactively increase bonus depreciation for 23 to 100%, but it did not pass. So we have that. There's also another provision which we haven't used much in the past couple of years because of the bonus depreciation called Section 179, which is another way to accelerate depreciation into the current year. There are differences, however, between California and federal and perhaps other states as well as to whether they recognize bonus depreciation or limits, different limits on how much can be accelerated via 179. So.
Are QCDs considered undesignated donations, or can they be directed to a specific sub-fund of the charity?
That you'd have to discuss with the charity. Yeah, I mean, they're going to basically get a check from either from your IRA custodian. I don't know that they would be treated once they're received as any other different from any other donation, but you would discuss that with each charity. So.
If okay, rental income is passive income. Does the profit qualify for QBI?
Yes, it is both rental income, it's also investment income, and it's also qualified business income in most cases. So they can have multiple different designations on the same type of on the same income. So
how about renting out
although I guess the
timeshare?
rental income is not really designation is not really that important. It's really passive income or non-passive, and then qualified business income or non. So
How about renting out timeshares managed by the company that arranges the rental?
for QBI, I imagine is what they're asking. I mean, the
Probably.
rental would still be passive income or loss. It would generally be qualified business income if you're renting it out with the expectation of making money, right? And the fact that you hired a manager to manage the property or investment or the transaction for you doesn't disqualify it as QBI. It would probably not be materially participated in for most of these, anyways. So
there was a
even if you do
question.
not spend, oh, okay.
Yeah. The question was even also another question, even if you do not spend 250 hours, it can still be QBI.
Yes. 250 hours for that was a safe harbor published by the IRS. It's ridiculous and nobody uses it. You do not need 250 hours of material participation in order for it to be QBI.
There's still some confusion about underpayment penalties and the difference between withholding and estimated tax payments. Because if you paid your full tax, if you met a safe harbor at the end of the year with withholding, there shouldn't be any question about underpayment penalty. But
so the actual calculation of underpayment penalties carries forward any over or underpayment in each quarter. And so if you look at the form 2210 for the IRS or 5805 for California, right, that calculates these penalties, you'll see for each quarter, each tax quarter anyways, they determine how much of your tax should have been paid that quarter, how much was paid in that quarter, factoring in the appropriate proportional amount of withholding plus any estimated payments made in that period. And whether there was an over or underpayment. And then whatever that result is carries forward to the next quarter. And so if you've underpaid in one quarter, that means that you've also underpaid that amount in the next quarter, unless you make enough payments to make up for it. So even if you make an estimated payment at the end of the year to meet your overall safe harbor, you would still have underpaid potentially in the prior quarters, unless it was just because of a large income event in the fourth quarter.
Safe harbor is basically quarter based. Is that true?
Quarter based, yeah. But again, remember those tax quarters end in March, which would make sense, May, August, what? And then December, which makes sense. So the ones in the middle are kind of fuzzy. So yeah.
Many things with taxes are fuzzy.
Yes, that is true. That is very true.
I think that's all of the questions.
Great. So reminders. The IRS has long paid special attention to returns claiming real estate professional status due to a high percentage of taxpayers who claim it not actually qualifying, right? So if you're going to claim this on your return, be very sure of what the requirements are and that you meet them, right? I predict that a similar amount of special attention will soon be directed at returns claiming short-term rental losses. I actually didn't mention this in the last slide. I should have, I meant to. The short-term rental loophole that people are talking about is combined with what they call a cost segregation study, right? When you purchase a commercial property, such as a short-term rental or a regular rental, honestly, you take the purchase of the property and depreciate it over time. And the default is 27.5 years for residential property, 39 years for a commercial property, including a short-term rental, right? And so when you purchase a property, there's actually a lot of pieces inside of it that can be depreciated over a shorter amount of period and may qualify for bonus depreciation, right? And so the hack that people use is to buy a short-term rental property, materially participate in it, and then use a cost segregation on it in order to dramatically increase the amount of depreciation deduction, lowering the income to a huge loss, and then using that to offset income from other sources. Or if you're a real estate professional and not subject to the passive loss limitations, you can do this for any property, not just a short-term rental, right? So the cost segregation involves a real cost segregation, in a study involves people that will visit the site of it and an engineer that will review the building and the blueprints if they're available, any improvements that you've made, et cetera, and identify components of the property that are eligible for a shorter depreciation period than 39.5 years, right? Or 27.5 years, so that you can increase your depreciation deduction now and get a larger loss or a lower net income, right? The trade-off of this is that when you take depreciation, you are lowering your basis in the property, meaning that when you sell it later, you will have a larger gain to pay back. Or if you do a 1031 exchange, the basis carrying forward in the next property will be lower, and therefore your depreciation for that property. Oh, I've run over. I'm sorry. I didn't realize I wasn't paying attention to time. So I apologize for the individual that has time constraints. So, I imagine that the IRS will be paying special attention to short-term rental loss claims to make sure that they actually meet the 7-night and more importantly, the material participation tests. They'll also be scrutinizing the cost segregation methodology. There are DIY options available for a couple $100 where they'll just look at the Zillow listing or something and apply an arbitrary amount to it. I do not recommend those, period. I don't think that they're going to stand up to scrutiny. The actual studies are long court tested, have been around since the 70s at least, and it's not controversial. So, and again, Nimona would ask you to not let the tax tail wag the dog. So make sure that the investment that you're making and the investment decisions make sense, even without the tax benefits or impact that you are looking at. So, and that is the end of I did run a couple minutes over. I'm sorry for that. So
It's okay.
I have some additional time if the moderators do to answer any additional questions. Otherwise, thanks for spending this time with me in the morning, this morning, and I hope that you got something of value out of it. So this QR code will go to my calendar if you wish to make an appointment for a consultation, 15 minutes at least, just to introduce ourselves and kind of discuss what questions you have is no charge. And then from there, we can discuss whether it's a good idea to work together and what it would cost. So